This is the Friday, November 13th version of the Market Plus segment. Joining us now is Brian Roach. Brian, welcome back.
Thanks, Mike.
Thanks for making the trip to join us on Friday the 13th.
I saw that after I arrived. Didn't think any more of it.
All right. We have a lot of questions for you from our followers on Twitter and Facebook. I want to start building on something you talked about on the program. Drew in Montezuma, Iowa is wondering, for all the corn in the bin, should farmers sell the carry now, or will we see more profitable levels this summer?
Well, it's November, and typically this isn't the time of year to be doing anything from the grower side. But if you were to look at the market and say, where is there an opportunity, it's in basis. The spreads are very narrow, meaning there's not much premium over into the March contract, 7.5 cents, I think, today. And so when you say sell in the carry, you're typically looking for at least 12 into March anyway.
Sure.
20 something into May, etc. So right now the only play is sell the cash on an extremely strong basis. I think basis maybe has a little more upside here on into December. And then if you do that, you have to come back and buy that equal amount of bushels in futures.
And re-own it, true hedge in reverse.
Yes, and just look at it purely like it's still corn in the bin. If you look at it as though it's a paper trade, it might run you out in case things move on down lower. I think corn's at a level here that it's below cost of production. It's at a historical low. I think with this type of demand that we have ahead of us, even though it's a little lower as of this week, I think that would be how I would look at it. The attitude you have to have here, though, is make sure you have enough cash to carry yourself on into March, April, May, June. How El Nino unwinds into the front part of the year could dictate. It could actually mean that we have an El Nino style planting season before we really see any changes to La Nina. I'm not sure.
Sure. Now, you mentioned on there this demand we're going to see coming up. That's a hopeful tone for a lot of producers out there. These lower prices need to bring some stronger demand onto the scene. So we've got a question here from Ryan. He's one of our Twitter followers. He's at Ty Brody Logan. He's wondering, with two massive crops in a row, do we have any chance to blow through stocks in the next couple of years?
Yeah, I think so. I mean, you have to remember that stocks are below the level that we were at last year at this same time. We were almost 2 billion bushels this time last year. We're at 1.7. This report here was not helpful, adding 200 million bushels to the ending stocks number, and that's part of the bearishness this week in the corn market. But we still held the lower end of the range from a technical standpoint in corn, which I think is positive. But I'm not that pessimistic on ethanol, for example, that was moved down by 75 million bushels. It's just too early. Gas demand is very strong. Why we would think that ethanol would underperform when gasoline prices are driving demand 3, 5, 6% higher, I don't necessarily agree with. Exports is a problem. However, the South American corn crop will be smaller. It's going in late. It'll be a problem getting the second corn crop in with the late planting of the beans that we're seeing in Brazil. And we're also seeing, you're seeing a lot of flooding in Argentina and in the midsection of Brazil. So it's still very early. But my attitude is that, we've had two real good crops in a year, actually almost three. And so you look at that and say the odds of overperforming again actually begin to decline. And we have, I don't think weather is getting less volatile. And so I think you have to look at it and think weather will remain volatile. That'll give us plays. You just have to make sure you have enough cash on hand and that you're still attached to the market to get through it.
You bet. So you're selling when you can, when there's strong basis out in the countryside, not when you have to for cash flow needs.
Correct.
Now, you talk about 2 strong years of crops. We're seeing some troubles in South America. As growers are wrapping up harvest, looking out into March and April 2016, that planting mix is on their mind. And we've got a question here from Stu in Decatur, Illinois at the Farmgate blog. He's wondering, based on current market dynamics and price prospects, what should the 2016 corn-soybean acreage ratio be?
My thoughts are, first of all, we have a problem with wheat. And we have wheat at a level that's not going to attract, and we have the hard red winter wheat crop in the ground. But far as overall wheat acres, it's not that interesting. And we may see some wheat acres move over to beans, and that will probably prop up the corn number. I could see corn acres up 1.5 million to 2 million acres potentially.
Planted acres.
Planted acres, yeah. And some of that coming from beans, but also getting some swing acreage from wheat.
Okay. On the soybean side, are soybeans going to stay the same? We'll see some pull from cotton, some from wheat. See a soybean increase. Where do you land on beans?
In November. It's really tough to tell because weather will really drive the final decisions on that. But if you look at row crop producers who have cash rents on the hook, they've got to put it into something, which is what the question I always get is, well, it's got to go somewhere. And I think that prices in the spring will dictate some of that. But as prices continue to decline, I think if you look at total planted acres, they do tend to come down. This year they came down a couple million acres, and if you look at the overall picture with low prices, we do tend to pull out total planted acres by 1 to up to 5 million acres a year.
So could be fairly substantial if 5 million acre drop.
Well, historically we've dropped those types of numbers. Whether we see that this year or not with cash rents where they are,
Sure.
I'm hearing they're not getting the kind of adjustments that growers really want.
Not that I've seen in central Iowa.
And I'm guessing that's not the case, but where you have to look is the fringe states, and can they make it work with the type of basis levels they have for corn and soybeans on those fringe areas, and that really will be where I think some of the decisions are made.
All right. Now, we had a good discussion about the cattle market on the program, and we've got a question here from one of our followers in Nebraska. This is from Lee in Nebraska on Twitter. He is wondering, what can producers do to narrow the basis in northeast Nebraska and Iowa, where we've seen the board trading off the south? Bids haven't been phenomenal in that part of the world. Anything producers can do there to narrow the basis?
I'm not so sure that the farm feeder has leverage over the packers, over the feedlots, and how the packers are treating them. So I think the real question, or the real problem there is that you just don't have the leverage that you would like to have, and the packers are drawing in, and there's a question about the number of market-ready animals here, and that there could be maybe a small disconnection, a disruption in supply, and I think that's what's driving some of the volatility here in this market this week. But the answer to the guy's question there is I'm not so sure you really have leverage over where the bigger volumes are at the feedlots and how the packers are managing that. I'm not so sure. I was talking to a guy about farm feeders contracting and then the packer waiting for a week, 2, 3 weeks before they're picked up while the weights were increasing. And I don't think that situation is going to go away, and there's probably a lot of farm feeders out there that are seeing that.
Okay. Now, his follow-up question was, as it relates to the volatility we've seen in both fat cattle and feeder cattle, should the CME bring back pit treating to decrease the volatility? Would people in the pit make a difference?
I don't think so.
Okay.
No, I've had my own experience with a pit trade, and the problem is there's not enough volume to really drive it. The reason it's not there is because there wasn't volume, and in some cases, my own personal trading experience is that there's humans in the pit, and they don't always give you what you really want, even though you think they would. They're not. They don't have your situation. They don't have any investment in you necessarily. And so there's been times where I would rather run it through the electronic trading so they don't know who I am. I stand a better chance with a little bit more volume than I would in a pit situation.
All right. Now, we do have a final question here, and this one came from one of our producers here on Market to Market. So we're curious, with the potential for oil to drop under 40 again, is that going to have an impact on the broader ag commodity world? Does oil as a benchmark commodity change managed money's views of commodities as a basket?
Yeah, I mean, I think there's certainly a money flow issue there when you have one of the biggest parts of the commodity index fund in oil making new lows here. It's oversupplied. It is a big negative when you look at the overall commodity index. As it pertains to the ags and corn particularly, I think it's maybe part of the reason we saw corn ethanol demand notch down as you look at sub 40 crude oil and how in today's market, the ethanol is priced too high relative to RBOB by 22 cents. And so from a future standpoint, those blending economics are negative right now, and they've been negative for a little longer than what I've seen them before.
Okay.
So I think those things are weighing on the upside in ethanol, but I don't think they'll last forever.
Okay. Well, with that, Brian, we will let you go. Thanks for taking the time to join us this week.
Thanks, Mike.
Thanks to all of you for your questions via Facebook and Twitter. Please continue to send them in, and we will get expert analysis right to you. Thanks for watching, and have a great week.